Today, I have a very special guest for you. I got to sit down with someone who has helped his clients raise over $200 million in capital to launch their ventures from any stage from seed all the way through to Series A and B. He's not only helped his clients achieve this, but he's actually written a book on the matter, and it's called The Investable Entrepreneur. James Church has literally worked with hundreds of entrepreneurs to help them get their dreams into reality. If you're looking to raise capital, then there is literally no better 40 minutes to spend than listening to how James breaks it down. There's a lot of tidbits in here and insights and just deep knowledge that I am beyond grateful that I got to have his ear for 40 minutes. So I hope you guys get as much out of this as I did. Enjoy.
Welcome to Successful Scales, the show where I talk to world-class professionals on what it takes to scale successful businesses. I dive deep asking questions to people who are running unicorn businesses, to raising funds, to buying businesses, mergers and acquisitions, IP and patent law, what is to manage performance management. I mean, the list goes on. The idea really is, how do I create knowledge and learning for you guys listening in? And of course, myself, getting the floor with people who I, in many cases, would never dream to share a room with. Before we jump into the episode, I've got to give a special thank you to our sponsors. Firstly, over at Global Wide Advisors, a leading digital consumer products investment bank focused on optimizing the sales process. An incredible team, always happy to pick up the phone and educate you or anyone about the sales process and what you should really consider, and can obviously help take you to market or even acquire businesses. I ring them for just about everything these days. Us over at Multiply Me, we are the end-to-end executive search and HR function into the Philippines, helping find better talent and onboarding them effectively. And last but not least, Escala, our management consultancy focused on process improvement, where we help build better systems for your business. That's all the ads you're going to get from me, ladies and gentlemen. The rest is all about learning. I hope you really enjoy and get as much out of these sessions as I do, sitting face to face with some of the world-renowned leaders in their respective fields, asking them the tough questions that they're not often asked. All right, guys, welcome to another episode of Successful Scales. You're in for a treat today. You are going to be listening from the co-founder of Robot Mascot, who is doing some really exciting things. I'm going to let James actually introduce himself, as I always do. So with that said, James, I'd love to pass it over to you and let the listeners learn a little bit about yourself.
Lovely. Well, thanks for having me here, first and foremost. I'm James Church. I'm the author of a best-selling book called Investable Entrepreneur. And as you rightly said, also the co-founder of a company called Robot Mascot. And we're essentially an investment readiness agency. We help founders at pre-seed, seed, Series A to raise investments so they can launch their business and scale. Clients have raised more than 200 million to date, trusted by VCs all around the world to support their portfolio companies, and won a number of awards to go with it too. So yeah, that's us in a nutshell.
Definitely the right person to be coming to when raising capital, because I would say that's the most succinct intro that I've heard to date, and you really hit on all of the markers. So we're off to a good start. Well, I mean, I guess my first question to you, James, is, and we'll get to the book a little bit later on, but obviously you found a really important niche. You're helping founders who are looking to raise capital to actually achieve it. And you've done exceptionally well helping, I think you said, north of $200 million in capital raised to date. When should someone look to actually seek raising capital? When does that make sense for founders?
Oh, wow. I mean, it really depends on the founder and the business model, but I think there's a few key points, right, through your journey, and it depends on the resources you currently have available, right? The whole idea of funding is for founders to access resources they don't currently have available, and that resource in this case is capital. So, in most cases, you need to have done something. You need to have built a proof of concept, developed some kind of research thesis that backs you up. But I think there's the key phases in there, sort of pre-seed, trying to having kind of established a sort of a thesis and proven that, trying to build an MVP to establish that there is genuinely a need for what you're building and that your solution's the right solution. And then there's the seed round, which would be looking to, the point in which you've maybe got some first customers, or you've got a market ready product, and then you've got your scale up rounds, your Series A, when you've maybe hit $1 million in revenues and are really starting to fly. So I think there's different points. It's much easier to raise the further along the journey you can get yourself, but obviously most founders need to pump 80 to 150, 200k of their own cash into the business to get started, and not everyone has the rich uncle they can turn to get that friends and family money. So you might need to find yourself raising a little bit sooner than that. But it's all about scale. Don't go off raising a couple of million when you're in that phase. Raise 10, 20, 50 grand to prove the concept. So it's all about making sure you raise the right amount at the right time for me.
Yeah, great answer. I know it was quite broad in my question, but you did answer it. I was looking at it from the lens of founders who are, we're a bootstrap company, and I think we've done relatively well without taking on investment, but a lot of that is probably a byproduct of the model, the financial model that we have, and that's that helps. We're a service business, whereas if you're a SaaS company, you need to invest a lot of capital into bringing on development capabilities before you can actually go to market. Then the whole journey shifts, and so I guess.
Yeah, exactly. So we work with people in hospitality and retail, service industry, SaaS tech, hardware, and everyone can get to a different point in their journey. So some of the really cool kind of heavy IP stuff that we're working with, sort of university spin-outs, they've already raised maybe 5 million in grants before they've got to a point where they can raise some equity investment. So it's a whole different journey again. So it's really bespoke upon each situation, I think. As much as everyone loves to kind of band everything, like almost group startups into one homogenous group and investors into one homogenous group with a hive mind, and they all think the same about every deal, where the truth is it's much more nuanced than that.
So let's dive into that a little bit. And I would agree with you. At the end of the day, when someone's investing capital into your business, the goal ultimately, whatever that time horizon is a return, an outsized return. They want to put in $1 and make $5 or $10 on the back of it. And so you mentioned hospitality, and I know when we had a previous conversation, it was quite diverse in terms of the types of companies that you're looking to help support, from SaaS and fintech and, even into a few other interesting verticals. And now you've mentioned hospitality, and I'm curious, what are, like, if we were to niche down and look at a couple, so let's, I'm going to throw out a service business in the hospitality space versus, let's say, a SaaS company, like from the investment side, from the potential investors, like, do you see different experiences that they might have had, different objectives and outcomes? Like, what, if we look at them individually, not to look at them as a homogenous group, like, what would your advice be to someone who is in the hospitality space that was looking to raise? And then I'd love to hear the same on the SaaS side.
Yeah. Well, what's interesting about both of those that you've picked is obviously both require huge amounts of upfront capital to get going, right? If you're going to have a new restaurant, a hospitality business, or to use a client of ours, they were a multi-sports venue. You could turn up and it was like great for parties and stag do's. You go and have 10 different sports in one venue with a bar, restaurant, that kind of thing. Now, obviously they needed all of the infrastructure to do that. They needed all the equipment, they needed the venue, they needed all the lighting and the music and all of that stuff, all of the kitchen, all of those things. So huge amounts of upfront capital needed. But I think a founder that just came up with that idea, having no experience in hospitality before, is never going to raise the funding for that. So this founder had already had a successful venue in Ireland, and he was bringing it to Portland in the States, and he was raising investment in the States to launch a new business using the same model that had been successful in Ireland, where there's a tiny city, tiny market, but then if we do this in somewhere like Portland, it could be huge. So that was the thing, was the founder there. Like, why am I going to back this sort of brand new concept with all of the capital it needs to get going is because the founder had past experience, and they got that by investing their own capital into and getting a bank loan for something much smaller to begin with. And I think the same is almost true with SaaS, right? You need a huge amount of capital up front often, but we need to see, you've got the founders with experience that have done this before, and they'll go and raise a few million off the bat just because they've already made investors loads of money. And then you've got the founders who are doing this for the first time, and you have to take a different approach and kind of say, well, what can I do as a minimum viable product, a tiny little version of this, where I can just raise a small amount of capital and then make the leap. So again, it's like how far are you as a founder? Because ultimately, the way I approach this and the way we approach this at Robot Mascot is investors aren't investing in businesses. They're not investing in business concepts. They're investing in founders. And the amount you raise and the stage of the journey you need to be to start raising capital very much depends upon you as a founder and where you're at and the experience and credibility and authority you have in your space. And the trouble we have is a lot of the big rounds that get talked about by Crunchbase or TechCrunch and the like that get all the headlines. You see someone go off and they've started a business in 6 months, they've raised 10, 20 million for this idea. And you don't really realize, I think, as a founder coming into this new, that's because they've already successfully exited a business and made those same investors that are investing in them hundreds of millions in a previous business. So it looks great. I can go and launch a business, have this great idea and raise millions for it. But actually those stories, those big rounds you get tend to be off the back of an individual or a team that you've brought together. And just on that note, like a good example of this would be a company of ours that we worked with called Plend. They're a fintech platform. They are a crowdfunding platform for people who they could determine as subprime. So if you don't have a good credit rating, there's like a big market of people that are good enough to lend to. They just don't meet the traditional lending criteria. And they do crowd lending to them. Now, they wanted to get this off the ground. They needed huge amounts of capital, both to build the platform and the algorithms, but also to the crowd to invest in their customers. Now, they started with raising 300K, having already built wireframes and proof of concept and that kind of thing. And as a result of us working with them to pitch that, they ended up raising 500K, I think it was. So they overfunded. But not only did they overfund, they managed to bring in advisors and a chairperson to the board who was highly experienced in this space, had launched and scaled and exited a crowdfunding platform. So they now had them as a chairman. Then they came back to us a couple of years later to raise their next round of funding, and they managed to secure 40 million in a seed round, got massive PR across Europe in Sifted and the like, everyone going crazy over this incredibly big seed round of 40 million. But it only happened because they were able to build a team around them that was so credible. They were able to raise a small amount to go and build an initial proof of concept, and then they went and raised the big round. So often you see the headline 40 million raised and you think, I could do that. I could launch and raise 40 million. But there's so much more to it than that's happened. It's years in the making to get to that point, and then bringing in these credible team around them to give them that credibility when they pitch to investors. So yeah, it's really about that. It's really about you, the founder, the team, and how you articulate to the market how you're the safe bet. You're the credible option. There's hundreds of opportunities out there, hundreds landing and invested. All they're doing is looking for that credible option. They're trying to sift through hundreds of pitch decks, looking for that one credible founder or one credible founding team that they can put their capital in. And the job isn't to sell the idea. The job is to sell your credibility. That's really what you're doing.
I mean, such valuable wisdom. And just to paraphrase and simplify for those listening in here, essentially, what James is sharing with us is that having a small proof of concept, if you've not gone down that journey, is highly valuable to likely get that next stage, which is how do I bring experienced, intelligent, capable people in advisory seats, or start to bring in their friends who might have access to capital, give them the right seats in the organization that allow you to, in this incredible case, I mean, if you're not familiar with the VC or just generally the funding space, to do a $40 million seed, I don't know that I've ever heard that before. So this is an incredible achievement for you guys and for the company. But they're bringing in these really high value people. They're overfunding that first 300 going to 500. So that already helps move the needle. And then once they've got this clearly high value proof of concept with all the inroads, they're able to explode the thing out. So it wasn't, like you said, James, this pie in the sky miracle. This one person had this great idea and people just believed in them. They believed in the team around it, and clearly the story that you were able to help them craft and go on that journey. I'd love to step back, because I obviously remember, and one of the things that really caught my attention when I was first made aware of you and what you're up to is you have this incredible free tool for anyone to use that is on your website that effectively asks a very, very extensive, detailed series of questions that helps you understand where do you actually sit in your funding journey. Have you funded before? Do you have your financial models intact? I'm just, this is very high level. There was probably like 60 questions that were involved in it around how well crafted it is. And coming back to, the question that I'd love to ask you is that in the book, which sort of leads to that book in this journey and obviously gives you a whole lot of high value insights, you broke down really eloquently to me sort of the key components that go into an ability to actually raise capital. And I'd love to hear what led you to writing the book, and can you just at a high level start to articulate what are the critical things that someone would need to get right in order to receive funding?
Yeah, so what led to the book was really getting asked the same questions again and again from founders, and there just seemed to be a no one source of kind of how does this work, and there's lots of blog posts, lots of conflicting information. I wanted to bring my experience into one place that took you from how to prepare a funding round, how to there's three sections to the book essentially. One is what do you need to do prior to a funding round, then there's the how do you prepare for that funding round, and then the final section being how do you actually find investors to pitch to in the first place? How do you manage and close that round? So the idea was to sort of take people through who'd never done this before, because the reality is most founders for their first round of funding have never done this before. It's never taught in schools. Even if you've done a business degree or something like that, it's maybe one lesson is on different sources of funding, and they'll talk grants and debt and equity, and it'll just be skimmed over. So no one really knows how to do this. And I think 1% of founders successfully close their round. 48% of founders go on to close their second round of funding. So once you know how to do it, once you understand the blueprint and you've got the experience in that, it becomes much easier. So I wanted to kind of really give that advice, and a book seemed a great way to do it. It became a bestseller, so I'm chuffed, and it's gone down really well in the market. The key things I talk about when talking about how to prepare for a funding round are these three critical fundraising assets, as I call them. And as I say, these things are more about the whole premise. And the reason the book's called Investable Entrepreneur and not Investable Business or Investable Idea is because of what I said earlier. It's about being the credible option, being the founder an investor wants to back, because there's loads of great ideas. Everyone can have a brilliant idea. Very few people have the ability to execute on that idea. So this is all about making sure you can demonstrate to investors that you are the individual, you are the team that can execute on this idea and make it a reality. So you have three critical fundraising assets that help you do that. The first is a business plan, which would dictate and document your business case for investment. It's a 8,000 to 10,000 word document. It's written on, in Word. It's not designed, and it's a flexible document that just says, this is the steps we're going to take. This is the action plan, both with the funding we raise now, but also in the longer term. These are the market opportunities we're taking advantage of. These are the market risks we need to be aware of, and here's how we're going to mitigate those risks. It's a strategic plan, no more than 10,000 words, because investors aren't going to read any more than that. But it articulates clearly in its longest form the reason the business needs to exist, the the route to success, not just the product development roadmap, but how are you commercializing the product? What are the growth strategies? How are you taking this to market? All of those key things. Once you've got that in place, and this is the journey you should go on, because you should start here. Most founders start with the pitch and end up having to try and work backwards, and it doesn't really work out very well. You should start here. That gets everything out of your head. It makes you feel like you've got everything down about your business, so you can be much more articulate in your pitch later on. You then have a financial model. That financial model should cover 5 years. It should have a P&L, a cash flow, a balance sheet. It should cover a 60-month forecast, so it should be monthly for 5 years. Why 5 years, not 3? Because a lot of people say a 3 year is enough, certainly at an early stage. For me, no investor is expecting an exit event to happen in 3 years. So an investor wants to see the ambition you have as to where you feel you can get this to based on all the market data you have, all of the what peers have achieved. Where do you believe as a founder you can get this to based on all the data, not just your kind of, because you love the idea, you think it's going to be turning over hundreds of millions, but realistically, based on what others have achieved in a similar space with a similar piece of technology, what's the kind of growth trajectory and where could we get to in 5 years to deliver a potential exit event? Now, you don't have to exit at that point. You could continue growing and move towards an IPO and raise more rounds of funding, but can we get to a point where there is at least a decent exit event that could give me a 10x return in 5 years? So that's what we're really trying to demonstrate here, as well as how do you manage money? How do you understand how cash flows through your business? When are your peaks and troughs in cash flow? When are things going to be tight? What's your burn rate? All of these things. What are your margins realistic for your type of business model? Your staffing plans, because founders make so many mistakes. They grow massively, loads of revenues, but they still have 12 people in the business, and it's just not realistic. And do you really understand what it takes at scale to operate and manage a business like you're predicting? Or are you completely naive to that, and therefore you're not the credible option? You've got a great idea, but you have no idea what it's going to take in terms of marketing costs, in terms of staff costs to operate a business that's doing 100 million in revenue. So you've got a lot to learn on this journey. And therefore, do I want to invest in you, who's got huge amounts to learn and probably going to make huge amounts of mistakes? Or do I want to invest in someone who really understands what it takes to build and operate a business of the scale in which you imagine? So that's what the financials are about. It's easy to put those as zeros on a revenue line. What you're really trying to show is I understand how to operate a business like my vision in sort of delivers. And then you have the pitch, the final critical fundraising asset, which is, of course, pitching all of this to an investor in a clear and articulate way. Now, not to go too much into stats and statistics, but just to throw something at your audience to make them think about how much they share. When we do outreach to investors, we have two types of outreach, right? One is clients that have been through our process, who've developed their business plan, their financials, their pitch deck. And we've got one where founders come to us and say, no, I've got all that stuff, just send it out to investors. Now, the ones we create using our formats and formulas, using this sort of structure with the pitch, where we make sure it's less than 18 slides, typically less than 100 words a slide, versus ones that founders that have created that are often 20, 25 slides, quite packed with content. The ones we've created that have less content and less slides get twice, actually 2.5 times the amount of time spent on it. So there's less information to read, but you get 2.5 times more engagement. And we also get 6 times as many investors make it to the end of the deck and read every slide versus a typical founder. So the truth is, a pitch isn't the business plan, and a lot of founders treat the pitch as a business plan. And this, for me, is why the business plan is the most important place to start, because once you've got it all out your system and you've written it all down in a business plan, you can afford yourself to be clear, concise, articulate with your pitch, keep it short, keep it engaging. And as a result of that, as a result of being brief with your business model in that first pitch, you're going to get twice the amount of engagement per investor, and you get 6 times as many investors read the full business model. And then you're going to get way more people want to meet you. And then you can talk about the detail. Then you can share the business plan, the financials, and go through all of that. So they're the 3 kind of critical assets. And it's all about almost a waterfall of information. You start with a business plan with all the detail, and then you work it through this process to having a pitch where you've just got that top level summary that just engages people, excites people, says the right things to investors in the right way to make them want to have a meeting. The pitch is not pitching for money, it's pitching for their time. The job of the pitch is to get them to say, I want to invest my time in finding out more about it, so eventually I'll invest my money. Not, will you invest your cash into me right now? It's will you invest your time into me right now? That's the job of the pitch.
I mean, I'm just sitting here nodding my head, just thinking through, like, I can just so easily see the trials and tribulations and the conversations with the likely hundreds, if not thousands of founders that you have had conversations with, trying to help them understand very clearly that it's almost like building that waterfall of most detailed to least detailed. And then it's just like marketing, right? Our objective is, how do we get them to open the email as a prospective investor? Tick. How do we get them to read through the entire pitch deck so that they'll get on a conversation or read the 10,000 word? Like, it's step by step. And if you're not approaching it in that way, where you've got the founders that tell you they know better and they're jam packing all the information, because we all want to get our ideas on paper. They're all the best ideas that anyone's ever had in their life. And if you fail to achieve any one of those stages, then you're never getting to that 10,000 word document, which is obviously the most critical step before you go into that deep interrogation phase.
That's it. So
part of me feels for you.
Yeah, I mean, look, you've hit the nail on the head. I often say this is no more than a sales process. And I think we're all aware of how, like, a B2B sales process, most people in business understand how sales work, or at least you would hope. And it's no different to a B2B sales process. It's just that in this case, the audience that you're trying to sell to is investors, and the product you're selling are your shares. And they need to see something of equal or greater value. If what they're buying, i.e. your shares, isn't of equal and greater value, they're not going to want to purchase it. In the same way, when you walk into a shop and you want to buy a new TV, if it seems overpriced for the features that it's got available to it, you're not going to pay for it. So it needs to be seen as equal and greater value. And when you look at B2B sales, you have the initial pitch, and the initial pitch isn't to get them to read is to get them to read the proposal. Then they read through the proposal in detail, and they'll shortlist you, and then they'll have some conversations with you, and then they'll decide on who their supplier is. And it's the same with investment. You just give them the pitch, so they invest their time in wanting to read your proposal, i.e. your business plan. And then once they've got the detail there, they'll book a meeting to they'll draw up a short list, and they'll book a meeting to go through and find out who it is they actually want to invest into. And bearing in mind, these are UK stats, but I think it's angel investors in the UK would make 2 investment deals a year. They're seeing at least 10 pitch decks a week, if not 50, if not 100, and they're making 2 investments a year. I mean, the strike rates works out something like 0.4% for angels. VCs, it's 1 in every 150 deals they see on average ends up closing. You know, you're fighting against a lot of others to get kind of through that funnel, that kind of initial pitch down all the way through the meetings, the conversations, the due diligence, to be the one that ends up raising investment. And if you can't impress them at every stage of that buying cycle, you're not going to make it through to the next round and end up being the one that they invest their money into. And that's what this process is about. It's not just about creating a pitch. It's making sure you have all the assets and all the information so you can hold your ground under investor scrutiny as you go through the rounds of due diligence through to a close.
Yeah, I mean, those stats probably would be more or less universal, I would have to guess. Even just given the brief experience that I've had sitting on the investor side. We had a joint venture with an investment bank and a fintech. We looked at 250 plus deals in the space of 18 months where no one came prepared to any of that information. So we had to pull out their financials. We had to go through this diligence phase. We made 2 investments out of 250 odd opportunities. So about the same. And, you know, the work that goes into that, especially when not organized, is terrible. If someone had worked with you through that process and come to us, you know, it pales in comparison to how seriously you would take that founder, because they've done the work. I mean, I think about, you know, it's almost like any, like you said, it's like any B2B sales pitch, but like the mindset is, think about these investors as the laziest people on the planet. It's not because they're lazy, it's because they're trying to sift through so much. If you can come and answer each of their questions at each stage of that funnel, then, you know, you are so disproportionately advantaged to move through that process. And when you think through what the upside yield is for you as the founder looking to raise capital, if you're able to, as an example, go down your process and have 3 or 4 investors now intentionally excited about what that prospect looks like, you can start to play them off each other effectively. And the amount of capital you can raise is crazy. And, I have obviously heard about what Robot Mascot's, model is. And it seems just beyond, it's not just fair. It's like, it's outsized. You are an outsized in terms of the investment versus the potential return. It is so outsized that it doesn't actually make sense. If we're to raise capital, why would I not go down a tried and proven process?
Exactly. So clients that raise are getting, the ROI is in the thousands of percent, because the rounds are so big, right? If they're, you're talking hundreds of deals worth at least a few 100,000, if not millions. So the returns can be huge if you get this right. And it does take some investment into this if you don't understand the audience. The pitch is about ticking certain boxes so you get through to the next stage. The financials, the system we have in terms of the way that we present all the information in a dashboard is all designed to pick out the key things we know investors are looking for. A financial commentary is written for our clients, so it's kind of an investment memo, internal investment memo. So it's written for the investor. If you're applying to a fund and you've got a junior investment analyst sort of being tasked to analyze all these financial models, you send yours with the investment memo we've written and you've done half the job for them. They can go, crikey, I can just copy and paste a lot of this and put it into this template here and send it on to the next kind of stage up the chain. I love these guys. I'm going to champion them internally because they make my life easy. So it's all designed, everything's designed in a way to make the investor's life as easy as possible. And like I say, not because they're lazy, because they're inundated with hundreds of deals and they're trying to sift through that to find that one credible option. It's a communication job. It's not about a business model, really. It's not about any of those things. We see ourselves as investor communications agency, really. It's about communicating that your business model in the best possible way so that it ticks all their boxes and gets through to the next stage of the process.
Yeah, and I promise I'm not getting any kickbacks here, guys, as I continue to push your model. But the reality, that I like to give, or the analogy I've given to people, is like I've gone through. I think I mentioned to you last time we spoke, Mac Lackey, a guy who's seen 6 of his own exits and multiple 8-figure exits on businesses. I went through his Exit DNA course, which teaches you how to go through that journey of exiting your business. You wouldn't sell your apartment or your house without a broker, right? Who knows the market, who can go down that process, and you're giving up a few points. I also wouldn't go down the path of selling my business without going to an investment bank or a broker, because they've got the market, they have the understanding. And also, I think one of the really important things that most people fail to think through is that there's a lot of stress that goes into raising capital, exiting a business, selling a house. These are big life decisions where you're putting your blood, sweat, and tears in. So having, even if it's just from a support perspective and a guidance perspective and someone to turn on that can take that stress off your shoulders, it's just an incredible thing. And I haven't seen many models like Robot Mascot. And that's why I'm so bullish about this, because it's like every stage of that life funnel of business stage, which these are a lot of the biggest decisions. You're spending most of your waking hours doing these things. If you're early stage and you haven't raised capital, or you haven't hit a meaningful profitability in your business, these are all of the most important decisions that you're going to make. And so I'm excited about your model for the companies that you can support.
Yeah, there's people have tried. There's lots of different ways. We just approach it from we feel incubators, accelerators, that kind of model, they're broken. We've had some global accelerators come to us going, how do you get the success? Because our clients we're taking equity in these businesses, putting them through our accelerator for 2-3 years. We're not getting exits, we're not getting growth, and most of them aren't raising funding to even get to the next step. And they're fundamentally broken, those accelerator models, because they've realized that 5 years in, they're not getting the exits they thought at the volume they thought, because people are failing through the process. And the truth is, you can only do so much in a group-based, low-cost accelerator where you're just telling people information. At some point, you have to action it, and that's the thing the founders struggle with most. They can get the information, or ChatGPT will tell you a load of stuff about what you need to do, but you have to be able to execute it. And we took it more as this needs to be to succeed, you need to invest in a one-to-one kind of done with you, done for you approach, where you bring in a team of business strategists, financial strategists, copywriters, designers, people who know the investment space really well, and ex-investment analysts as part of our team that have worked in big funds and small funds to be able to kind of shape that message for you, so you know what you need to say, and we can level you up as a founder through that process. You can't do that in an accelerator environment, in a group-based environment. You can give people the tools. We used to run a program that was a group-based kind of, here's some templates, go through, and we stopped it just because it was frustrating. A few people had success with it, don't get me wrong, but what was frustrating is that go through this, they'd invest in this 12-week program. I'd put, all my effort and heart into this to try and get them to, and they never executed anything. You say, here's the business plan template. You got a couple of weeks, go write the business plan. We'll have a few check-in sessions along the way. At the end, who's done it? 1 in 10, maybe. Then you get to the financials. Well, they're all way behind now. So you've got 1 or 2 people that are sort of keeping up. Maybe one of those ends up completing the financials. Barely anyone finished the pitch by the time we got to the end of that. And you just think, you're investing in knowledge, but no one's executing anything. And founders have got so many other things to do. Build the business, get their first clients, hire their first team, create the product, to then sit down and produce these assets and really research and understand exactly what investors are looking for is a whole nother job. It's a whole nother thing. And they just don't have the time to do it. Again, it's not because they're lazy, just like it's not the investors being lazy. It's just that they've got so much other stuff to do that taking time out of that kind of on the ground stuff to sort of have that top level kind of funding focus is really difficult for a founder to do. So it ends up being a quick kind of, I've got a couple of hours spare, I'll throw a deck together, and don't really put enough time and effort into really making sure that they're that 1 in 100 that goes on to actually be successful at raising investments. So yeah, that's the issue as we saw it, and that's why we created Robot Mascot, and I think it seems a lot of people agree, a lot of founders agree with us, and that's why they work with us. But it's the way of the world. You need to invest in people around you. Business is a team sport. No one's been successful. As much as you might have sole founders, it's a team sport. You have to have people around you. You win and lose as a team, and you have to bring that team of experts around you. And the experienced founders that have been there know that. They invest in our service quite happily because they realize it's a team sport. They need people, experts around them to leverage time and knowledge to get to their goals.
That is a fantastic line, that business is a team sport, and it really is. You cannot move mountains by yourself. And, all of us have our particular skill sets that we're good at. For me, there's maybe 1 or 2, and that's why I have 2 co-founders and business partners in my business. And that's why it's like super critical. You said something before, and again, I'm not trying to promote your model, but I think one of the things that is also unique to it versus an incubator. So I'm not talking about how you're running sort of the sessions over 12 months. I'm talking about a venture studio that's incubating, is that you open up the opportunity to many, many different VCs. And as a result of that, there might be very niche specific, whether it's skills and capabilities or even just the network that these people are involved in. And you have the opportunity to actually get someone in the right position to actually see success. Whereas in the incubator model, I don't know what the diligence process is for each of them and what the programs look like, but the reality of the situation is having that expansive opportunity to hit, potentially hundreds, if not thousands of investment vehicles will just simply allow you to be able to be effectively cherry picked by them in saying, this exactly fits our mandate and this is like a perfect fit. So I also like that distributed model. And then the last thing I'll say is, when you talk about that experience of having this team sport and the stages of that journey, being able to actually find a co-founder or bringing in additional people, I think is going to have a material difference. I know you probably have stats in your head, but there were some really interesting stats when we were talking a little bit about your ICP, and really what your ICP is who are the founders that are seeing success. And I'd love you to sort of run through the audience, like who as a potential founder or founders, like what are some of the critical things that will stack your cards in the favor of actually raising capital?
Yeah. Okay. Well, it's interesting you brought up co-founders, because one of the things that we don't see is a material difference between co-founder or sole founder in terms of when we look at who successfully raised investment. Where we do see that divide is what investors are investing in is teams, not individuals. So it doesn't have to be a co-founder, and I would tread carefully in kind of, if you are a sole founder listening and you think, I need to go and find a co-founder to raise investment. In fact, the data I've seen would suggest that the most successful businesses are sole founded businesses, because there's a single-minded direction and there's less falling outs. So what this accelerator model has perpetuated, things like Y Combinator, Techstars, those sorts of things. They look for co-founding teams because it's useful to them as accelerators to have co-founding teams, because there's more people to get more stuff done and they can go through the accelerator model and distribute the workload. And that has meant that angel investors start looking at this, VC funds start looking at this and going, well, that, Y Combinator have been successful, so we should probably follow a similar model. But actually there's no real data suggests longer term, yes, you get more resource for free up front, but longer term, there's more falling outs and that can spell disaster for the business. So I wouldn't go and find a co-founder just for raising investment. My co-founder was best man at my wedding. We were mates long before we were business partners. There needs to be that fundamental kind of connection where you can fall out and know you'll always come back together again, as opposed to fall out and go, oh, well, I'm done with this and walk off. Much like a marriage, right? This is a long-term commitment and it needs to be considered as such. So if you are a sole founder and you don't have a co-founder around you, it's about bringing in a team of advisors or handpicking some people that post investment would be willing to quit their job and join you on your vision. Because it's about being a resourceful entrepreneur and being able to access these resources like talent and like capital. And so if you can line up some people that are bought into this with huge experience, they're maybe giving some time for some small equity as an advisor, and then they're willing to quit their job and join you post funding, you're starting to form a team. And that's what investors really want to see. If you can give them shares in return for a lower base rate salary, they're bought into this, and that's what they want to see. They're not just going to leave after 18 months because things get tough. They've got a vested interest in it. So you want to build this team of advisors and people, employees around you if you're a sole founder. But yeah, you need to be someone who's focused on bringing in people around you, not doing all of this yourself. You want to be the innovator, the person at the top. You don't want to be the tactician doing all the legwork. You need people around you to do that. So in terms of where we see success, I mean, it's broad. Like the Plend guys we talked about, they were probably, at the time, I'm going to guess they were in their sort of mid to late 20s. So they had some business or some life experience, but not huge amounts. But we've equally had people that are in their 40s, 50s and 60s successfully raise investment, and they're using a lot more of their life experience and business experience in what they built. So we tend to work with people who are 40 plus, who have some kind of either corporate experience where they've sort of seen a huge opportunity that's not being solved in their corporate job. They've been experiencing that for 5 to 10 years, and now's the time to kind of go out on their own and sort of create a business that solves that problem. And they've got huge, deep sector expertise, a huge network they can rely on, all of those sorts of things. And then the other kind of group that we find work pretty well with us are entrepreneurial types that maybe on their second or third business. They maybe have a consultancy or an advisory business, and then now they've found a problem and they're now launching a tech company to solve that problem, and they're spinning that out of their existing operation and focusing on that full time. So they tend to be people with some kind of domain expertise, have real lived experience of the problem, have a solid network that they can reach out to and rely upon and get advice and contacts and potentially connections with investors through that network. Those sorts of people are, for us, the most attractive. I think for investors, probably the most attractive. That being said, it's there's plenty of young kids out of uni that go and raise lots of capital, but it's much harder. And those sorts of individuals, if you are kind of 18, 19, 20, under 25, it's about bringing some of these characters that I just mentioned with that real kind of deep expertise around you in that advisory team to say, look, we're driving this vision forward. We've got the vision and we're able to innovate. We've got the incredible coding skills, but we've got these incredible deep sector, we've got someone who really understands the market and they're built and they're experts in sales towards this target group. We've got this person who's an expert in technology in this area. We've got an expert who really understands the nuance of this market. We've got these people around us, and I've got a blog online with 4 different types of advisor, these different types of people you need around you to show that you have insights across that full market. And that's really what we're looking for is those sorts of characters with either a team around them that have deep sector expertise, or they themselves have that deep sector expertise, because that's the bit we can't change. That we can change the business model, we can better represent it, we can help them develop and evolve what it is they're pitching, but what we can't change is them. That's what we can't give them 10 years experience in a sector when they haven't got 10 years experience in a sector. So that's really what we're looking for, is those people, and then that comes across to investors very quickly when they're speaking to you as to how much you know this problem. And I think a lot of younger founders would probably do well, unless they happen to be on a run and have great people around them, they'd do well to go and get a job for a couple of years at a startup, be one of the first employees in, and kind of learn on the job, as it were. Kind of you're closest to the founder, closest to the decision making if you're one of the first employees at a funded startup, and you'll learn so much about what it's like running and building a startup that you can then go and take into your venture when you eventually launch it. Maybe some people have a tendency to rush into entrepreneurship without doing the kind of being an understudy first, be a number 2, be a number 3 before you become the number 1, and sort of learn what it's like before you jump there. And I think, certainly younger founders tend to jump straight to the end goal without perhaps doing a little bit of the kind of understudying beforehand.
No, I was about to say, therein lies the challenge of this next generation coming up, that they expect to be the founder or CEO before ever actually having an ounce of experience. So, right, I was going to ask you for some closing words and insights, but I don't recall being on a podcast where there's been this many nuggets of just sheer value. But before I let you go, James, is there anything that we haven't covered for founders who are looking to go about raising capital? Because I just really, it's so thorough. My head is spinning right now with just the sheer information that I'm trying to absorb.
Yeah, no, I think, the one takeaway is none of this is about your idea. Investors don't invest in ideas, they invest in entrepreneurs. Great ideas don't raise investment. Great communication does. So if you've got an incredible business that's looking to raise capital, think about it from the investor's perspective and say, you may think your idea is the best thing ever, but so do the 100 other founders that are pitching to that investor that week, and you need to cut through. So how do you cut through and show that you're that credible option? And if you focus on that, how do I build my authority and my credibility up in this space so that I become the only option for them to invest into, regardless of whether my idea is good or bad, then you're going to succeed, I think.
Fantastic. James, thank you so much for your time. I'm excited for everyone listening in to get this as a resource, and I would highly recommend both going down that process on the questionnaire. It was very illuminating for me and where we are at in our journey, and the book as well.
Well, I'll drop a little, if people want to do that quiz, they can go to pitchready.co.uk, and that will take them to the quiz. They can do the quiz, and at the end of that quiz, you'll get the option to order a copy of my book for free as well. So feel free to do that. Test yourself, benchmark yourself on your current ability to raise investment, and see where you land. Let me know what score you get as well.
Fantastic. Yeah, we'll drop that in the show notes. And James, again, thank you so much. It's been fantastic.
You're very welcome. Thanks for having me.